The parallels between the US and China's real estate markets are, in a word, alarming. From the disproportionate amount each contributes to their national economy, show figures of 20% of GDP for US and 25% for China, to their dwindling middle classes due to lack of affordability, and the most troubling thing of all, rampant government intervention. Throughout history, real estate has been an economic engine and the downfall of both. Over-speculation, bubbles, and the increasing possibility of a global domino effect. This is why US real estate is headed for a Chinese-style collapse. Behind China's real estate crash, the three red lines. The Middle Kingdom's property sector woes can be traced back to one thing: debt. Leverage, liability, obligation, whatever word you use to describe it. It has been the downfall of many countries and empires. Prior to 2020, China's largest property developers like the infamous Evergrande Group, Wanda Group, and Fantasia Holdings went on a debt binge, developing more residential apartments than there were people who could afford them and aggressively expanding into unrelated businesses like wealth management, electric vehicles, and even professional soccer. Something had to give, and in 2021, the largest of these property developers, Evergrande Group, came close to a Lehman Brothers-style collapse when it defaulted on billions of dollars worth of debt. Interest payments were reportedly later made after the deadline had passed, but the damage had already been done. The Chinese government's three red lines rule was created in response to regulate the leverage taken on by developers, limiting their borrowing based on their debt-to-cash, debt-to-equity, and debt-to-assets ratios. Property developers continue to struggle under the weight of this rule to this day, and recent statistics show that things are about to get a lot worse before they get better. The current US real estate landscape. Will prices ever go down? One of the best ways to describe the US real estate market today in 3 words or less is detached from reality. How else could you explain a median home price of $416,000 as of the second quarter of 2023? Down 3% from the first quarter, against a median income of just over $50,000, with a record $17 trillion in household debt. The only way this has been possible is due to a zero interest rate policy by the Federal Reserve and trillions of dollars worth of debt. But just as easily as the Fed helped inflate the current real estate bubble, and the one prior to it, the Fed is helping to burst it. By raising interest rates at the fastest pace since the 80s, it is driving up monthly mortgage payments on millions of adjustable-rate mortgages, from commercial real estate to single-family homes. Predictably, this has started a wave of defaults on everyone from hotel or EITs to institutional real estate investors. With sales activity slowing and the Fed raising rates again by a quarter point last month, while hinting at yet more rate hikes to come, the real estate market's days of consistent price appreciation have come to an end. Similarities and differences between the US and China's real estate markets. While there are no ghost cities consisting of hundreds of empty apartment blocks lining rural parts of Georgia and South Carolina, the similarities between the US and China's real estate markets are closer than one may think. For starters, rampant speculation driven by easy credit has created an artificially high demand for both new and existing homes in both countries. In so-called Tier 1 cities like Beijing and Shanghai in China, homes cost around 14 times the average salary. If you want to buy a home in Los Angeles today, it will cost you more than 18 times the average national salary. The second stark similarity is the demonstrated preference for government intervention over market economics in both the US and China. Centralized interest rates, implicit rather than explicit price support, and bailouts over defaults have created the unsustainable, inorganic price growth we've experienced over the past decade. Sure, there are also key differences, such as 70-year property leaseholds in China, compared to permanent property rights in the US, high property taxes in the States versus little to no property taxes in China, and a transparent housing market via the MLS database against a closed one in China with no single source of reliable housing data. However, these differences have had less of an overall impact on each respective market than their similarities have. Navigating the storm ahead. Why US real estate is headed for a Chinese-style collapse. After the longest property bull market in US history with consistent price appreciation since 2012, Home values finally started declining at the end of 2022, according to the Samp Case-Shiller Home Price Index. The current cycle of over-indebtedness, combined with steadily higher interest rates, will tip the market over if it is not reversed. There are also some other potential catalysts lurking around the corner. Hello, commercial real estate. By definition, a bubble has three stages: price growth driven by speculation, credit expansion, popping of the bubble. Having gone through the first two for the past decade plus, we are now entering the third and final stage. Hold on to your iPhones, it could be a bumpy ride. There's no question that the Fed will step in and intervene just like their People's Bank of China counterpart, attempting to prop up prices like in 2009. Only this time it likely won't succeed. After revving up the money printer to the tune of more than $10 trillion in 2020, 80% of all dollars ever in existence, it may be out of paper bullets to save the market this time around, meaning there may be no bottom to how low it can and will go.